And welcome to day 18 of the Boat and RV 100 series. I'm Joe Downs with Storage Moguls, and today I'm showing you the math behind one of the most important operational realities in this vertical: why a 100 space boat and RV facility has less margin for error than a 400 unit self storage facility, and what that means for how you underwrite, operate, and retain tenants. And this isn't theory, folks. This math directly shapes every retention decision we make. By the way, if you want the full deal evaluation framework and to be on the receiving end of some free AI powered tools, you should register at storagemoguls.ai, storagemoguls.ai. We launch in a couple weeks. Register now, reserve your spot. You'll be in, you'll get the notification, and you'll get a free deal analyzer GPT we built and use ourselves. And why we built it is we're a community made up of real people, actual operators like you and me. Nobody in our communities selling you some fantasy from behind a microphone without ever walking in the storage operator's shoes. We're a network that actively evaluates real deals, acquisitions from 400 grand to a couple $1 million, actionable real deals. And we're about real results. Members in our community are becoming storage moguls every day, not someday, every day. You can start for free. You can level up at your own pace. But back to today, because the math on fewer spaces changes everything about how you think about this asset class. So let's start with the core math. Let's say same 10 vacancies, and let's look at how it's a very different impact. In a 400 unit self-storage facility, 10 vacancies, that's 2.5% of your inventory. At $125 a month per unit, that's $1,250 in monthly revenue. It's real money, but it's cushioned by the remaining 390 units. In a 100 space boat and RV facility, 10 vacancies represents 10% of your inventory. At $175 per space, that's $1,750 a month in revenue loss. And that 10% occupancy hit is a number that shows up clearly in your NOI and your lender's stress test. The boat and RV facility actually generates more revenue per space than a typical self-storage unit. So the absolute dollar loss per vacancy is higher, not lower. And the proportional occupancy impact is 4 times greater. This is the math that makes retention not just important, but operationally critical in this vertical. Losing 10 tenants in a self-storage facility is a manageable event. Losing 10 tenants in a 100 space boat and RV facility is a significant NOI event that you may feel immediately. So let's run the actual break-even math on a 100 space facility so this isn't abstract. Assume 100 spaces at $175 per space per month average rent, and $8,000 per month in fixed operating costs. Your break even on that is 46 occupied spaces, 46% occupancy. Below that, your facility is running at a loss. At 85% occupancy, you have 85 spaces generating $14,875 per month. You subtract out your $8,000 in expenses, and that's going to leave you with a $6,875 NOI per month. Now you lose 10 tenants. Your occupancy drops 75% to 75%. Revenue drops to $13,125. Subtract out that same $8,000 in monthly expenses because your fixed costs don't change. Now your NOI is $5,125 per month. You just absorbed a $1,750 monthly revenue drop that translated to a 25% NOI reduction. At a 400 unit self-storage facility with comparable numbers, losing 10 units would represent a much smaller proportion NOI hit because the revenue base is 4 times larger, while fixed costs don't scale proportionally. This is why every retention decision at a small boat and RV facility is a material financial decision. It's not soft, it's math. The space count math drives every operational standard in this vertical. Here's how the math translates to specific operating behaviors. 1, you need to resolve problems in one call. Every unresolved complaint is a potential vacancy. At 400 units, losing one tenant over an unresolved complaint, it's 0.25% occupancy. Not a big deal. At 100 spaces, it's 1%. The same operational failure has 4 times the proportional impact. All right, 2, so let's look at proactive outreach before renewal. Don't wait to find out who isn't renewing in September. Call your tenants in August, before the fall market heats up and they start evaluating their options. Ask how their season went. Ask if there's anything they need. The tenant who knows you by name and had a good summer is more likely to renew than the one you haven't spoken to since last fall. Number 3, know your at-risk tenants. Which tenants haven't accessed their space in 90 or more days? Which ones complained last month? Which ones are on a month-to-month lease? This is your watch list. Build it, work it proactively. 4, price increases with care. A $20 monthly rate increase across all 100 spaces generates $2,000 a month per in additional revenue if nobody leaves. If 3 tenants leave over the increase, you've lost $525 per month and you're down 3% occupancy. Run the math. The increase only works if retention holds. All right. 5, treat your long tenure tenants, long-term, same thing, as strategic assets. A tenant who has been with you for 5 years, never misses a payment, might have referred 2 neighbors or who also became tenants and never complains is worth dramatically more than their monthly rent. They have a lifetime value. It's rent plus referral plus the stability they add to your occupancy baseline. It's pretty significant. Rate optimization is one of the highest leverage moves available in boat and RV storage, but the space count math cuts both ways. A $10 monthly increase across 100 spaces generates $1,000 per month in additional revenue if retention holds. In a market with strong demand and waiting list, it likely does. In a market with alternatives nearby, a few tenants may leave, and each one erodes the gain. A $20 increase is more meaningful, $2,000 per month, but the retention risk is higher. If 5 tenants leave, you've lost $875 per month at an average of $175 average rent. Plus, you're now 5% below your prior occupancy. The net is still positive at $1,125 per month, but you're now more exposed to the next vacancy event. Framing matters here too. A rate increase that coincides with a visible facility improvement, maybe you paved the aisles or new coverage structures or upgraded security or added a new rent station, is significantly easier to defend than an increase with no corresponding investment. Tenants in this vertical respond to operators who invest back into the facility. And your timing matters too. The fall move-in season is the highest tolerance moment for new rates. Demand is high, and tenants who are moving in already are committing to your facility. The spring renewal is your lowest tolerance moment. Tenants are about to move their vehicles out for the season, and they may reconsider their storage arrangement while doing so. The right answer is to implement rate increases in the fall, frame them around a facility investment, and do personal outreach to any tenants you believe are at risk of leaving over the change. Here's how the space count math translates into specific underwriting adjustments. For vacancy assumptions, don't use a flat 5% vacancy assumption the way you might in self-storage. Build a monthly vacancy model that reflects the seasonal cycle. Lower vacancy in fall and winter, higher in summer. A 15 to 20% annual vacancy average is normal and healthy. A 5% flat assumption will overstate your stabilized NOI. When you look at the sensitivity analysis, run the scenario where fall occupancy comes in 10 points softer than your base case. At 100 spaces, that's 10 tenants and a real NOI event. If the deal doesn't work in that scenario, you're buying with insufficient margin for error. When you build a CapEx budget for retention, budget for amenity investment in your pro forma. Plan to add an air station or a rinse station, improve lighting. These are not discretionary at low space count facilities. They're retention spending. If you don't budget for them, you'll find yourself making the investment reactively after you've already lost a few tenants. When you budget for management costs, don't underestimate it. One call resolution requires someone who's empowered to act and reachable when tenants need them. Early mornings, evenings, weekends. That's a real labor cost that needs to be in your expense model. And then there's your exit valuation. A stabilized 100 space boat and RV facility with documented 90+% fall occupancy and a waiting list commands a meaningful premium over a facility at 75%. Build toward that outcome from day one. That occupancy history is your exit story. Here's the retention investment math laid out explicitly. Because operators who see the numbers clearly make very different decisions than the operators who treat retention as soft operational goals. What does it cost to lose one tenant? Revenue lost during the vacancy period typically the 6 to 8 weeks of the summer average rate, call it 250 to 400. What's the marketing cost to fill the space? Signage, online listing, 50 to 200 bucks. Manager time to show and onboard a new tenant, another 75 to 150. And the risk that the incoming tenant is at a lower rate than the outgoing one, which is real if you're filling in a soft period. Total cost to replace one tenant might be 375 to double that to 750 or more, depending on timing and market. So what does it cost to keep that tenant? What does a proactive call in August that takes 15 minutes cost? A fee waiver on a late payment concern, what's that? 25 to 50 bucks? An amenity investment per tenant per year, a share of the maintenance cost, maybe that's 20 to 40 bucks per tenant. A personal note after a problem is solved, maybe it takes you 5 minutes and costs nothing. Total cost to retain one tenant for the year, I bet you it's under 100 bucks in most cases. At 100 spaces, the math is not subtle. The cost to lose one tenant is 3 to 7 times what it costs to keep one. Multiply that by any churn you're experiencing, and the financial case for investing in retention is overwhelming. Here's the frame you want to carry with you at every boat and RV deal. Know the math. At 100 spaces, every 10 vacancies is 10% occupancy. Calculate your break-even occupancy on every deal before you bid. Know what a 10 vacancy event does to your NOI. Model it in your downside case. Invest in retention. One call resolution, proactive annual outreach, amenities. These aren't soft amenities for these aren't soft operational preferences. Investment, personal touches, they're financial decisions with calculable returns. The retention investment math on slide 7 shows that keeping a tenant costs a fraction of replacing one, so budget for it. Price rate increases with retention math, not just revenue math. A rate increase that causes 3 tenants to leave may cost you more than it returns. Run both numbers before you implement any rate action. The operators who internalize this math operate differently. They pick up the phone faster, they waive fees with less hesitation, they spend more on amenities, and they generate better retention, higher fall occupancy, and stronger NOI than operators who don't run the numbers. All right, next up, day 19, we will dive into cap rates and valuation, fewer comps, more operator judgment. Please like and subscribe if you don't mind by ringing the bell so you get notified about every daily drop of these videos. And finally, share this with someone who owns or is buying a boat and RV facility and they haven't even thought about or built a retention model into their operating plan. They'll thank you later. And remember, at 100 spaces, every vacancy is 10 times more expensive proportionally than 1,000 units. The math drives the operating standard. The operating standard drives the retention. The retention drives the NOI. It all starts with understanding the economics of fewer spaces. For the full deal evaluation framework and deal analyzer, join the Storage Moguls community for free. You can do it right now after you share this video. StorageMoguls.ai, StorageMoguls.ai. You can start for free and level up whenever you want. And if you register soon, remember you get that free GPT we built and use ourselves. And remember, folks, mechanics of boat and RV storage is what brought you to this video today. Wait until you see how we teach people how to understand and evaluate all the other verticals that make this asset class that much more exciting. So you should join us at Storage Moguls. If you do, we'll transform you from someone interested in boat and RV storage to a storage mogul that your friends will start talking about in really good ways. Tomorrow we tackle valuation, how to build your own comp argument, and when there aren't any comps to work with. See you tomorrow.